Hello there, Salim Omar here from Talk CPAs. Today we're going to talk about a very important subject, and that is choosing the right legal structure for your business. And I'm joined by Rod Dillo, CPA from my firm, and we're going to talk about why this is important and give you some really valuable nuggets, gems for you to incorporate and consider for your business. Rod, welcome.
Oh, thank you for having me, Salim. I really look forward to talking about this subject.
Awesome. Great. So why is choosing the right legal structure important? Perhaps we can start there.
Choosing the correct legal structure can make or break your business. It all depends. There's a lot of questions a business owner has to ask themselves, like, do you have valuable or risky assets in your business? Do you need to protect them? Do you have multiple owners? Do you want to limit your tax liabilities or allow for future growth through outside investors? These are all questions that need answered so you can pick a legal entity, a legal structure that's right for you.
Got it. Yeah. And I know you're going to give us some pros and cons for some of these entities, some of the common ones that you see, some of the mistakes that people can, should avoid when choosing a legal structure. But first, what is a legal entity?
A legal entity is how your business is organized and is treated by both the courts and the tax authorities. It's basically, it can in effect create a separate individual outside of yourself, or just guide how you're taxed and how things interact with you in the courts of law.
Got it. Yeah. Perhaps, an example or two of how does legal entity affect a business owner?
I'd be happy to. Let's say I'm going to call him Chris. Chris starts at the beginning of 2021, decides he's going to start a landscaping business. He has a truck, some mowers and other equipment, and a lot of ambition. He did really well his first year, earning, after all his expenses, $100,000. Chris didn't pick a legal entity, so by default, the courts and the taxing authorities call him a sole proprietorship. So basically, Chris is the business and the business is Chris. For taxation, Chris would owe $15,000 in regular tax, assuming that's his only income is from the business. Plus, because he's a sole proprietorship, owe another $15,300 in self-employment tax for his portion of FICA and Medicare. So his total federal tax bill would be over $30,000.
It's a chunk of change. I mean, Chris makes 100,000. Of that 100,000, he's paying 30,000 in taxes, which is income tax and self-employment tax, Social Security, Medicare tax.
Yes.
Got it.
Yeah, and that's a big trap that a lot of first-time businesses fall into, not realizing that double taxation. Using that same information, say, Chris went to a CPA advisor who helped him form an LLC, limited liability company, which we'll talk about a little later, and elected S corporation tax treatment for it. Also, we'll talk about later. In that same example, Chris paid himself $50,000 in wages because he's an employee of his business now. His CPA would have helped him set that all up and help him walk through all that. Now, after paying himself, he has $50,000 in net income. The $100,000 in profits he had originally minus $50,000 in wages. Chris would still owe the $15,000 in regular income tax because he still has $100,000 income on his return. But the key piece is he does not owe any self-employment tax on that $50,000 of net profit that he had. So at that point, he's basically saved himself $15,300 on that self-employment tax. That's a big savings, So you take your a $30,000 bill and reduce it to closer to 15. That's a significant advantage to a taxpayer. That's more money in his pocket for his business or himself. I just real quick want to touch on the liability side, not just the tax, because that also is the same thing. If Chris got in an accident in that business truck when he was the sole proprietorship, if his insurance didn't cover the damages, now people could personally go after funds he had outside of the business. So his personal checking in his home could be subject to judgment if he was in an accident with that work truck. If he, in the other example, when he formed that LLC, had that same accident, the judgment would be limited to whatever assets were in the business. It would hurt Chris's business, but his personal residence, his personal savings would not be exposed to that court action. So again, it's both tax and for legal protection that legal entity structure can be very, very advantageous.
Very interesting. So sole proprietorship, I mean, that's one of the entity choices that a business owner has, in terms of existing, how the business exists. And from the sounds of it, it doesn't seem like it's the best one.
It's not. It's really what it is easy. It is. It's you basically don't have to do anything. So it's not one I would recommend. There's much more advantageous ways to be organized that don't require that much work. But it's the default for if you haven't done anything and you're only one member, you're only one owner, you're a sole proprietorship. So that's really, it's the default.
Right. And it's probably okay. It's probably right for a business that's very, home-based. There is no, from a liability standpoint, there is not much there in terms of liability. But even from from an income tax standpoint, it seems like, there's going to be a higher tax that the sole proprietor is going to pay. So what's the other option in terms of entity choices?
Oh, there's really three additional ones. Partnership, which is a business that has two or more owners. Those are still relatively straightforward. They are a separate legal entity from the individuals. So they need to have their own registration numbers, with the, registration numbers with the IRS and the state authorities. And they do owe a little bit of more paperwork in that there should be a partnership agreement. That's not required, but it's good business to have it, basically agreeing on how things are going to get run. Those are still do not protect the individual owners from liability, and they still expose the owners to higher levels of taxation potentially because they still are subject to self-employment tax and other items. So it's almost, for partnerships are almost sole proprietorships with more than one owner. They are separate legal entities, but they don't protect you legally from judgment. The next one is probably the most common one you're going to see now, called a limited liability company. These are entities created by state law. So each state has their own set of laws governing how to form and operate a limited liability company. They're relatively easy to form. They are treated as a separate legal entity for both, for liability purposes especially, and then you get to choose how they're treated for taxation. If there's more than one owner, you can pick being treated as a partnership, or you can elect to be treated as a corporation, which I'll talk about in a minute. If you're a sole member, you can still pick sole proprietorship treatment, or once again, choose corporation. So there's a lot of flexibility on taxation, and you get that ability to protect your assets from court action outside of what's in the business. So very flexible, very, very user-friendly.
Got it.
The last choice is corporations. These are a separate legal entity. These are everything from IBM to, a mom and pop down the street. These are formed as legal entities, have their own. They act as their own person. They are treated as that for both court actions and for taxation. depending on how you elect them to be treated, they can either pay their own tax at their own tax rates, or it can pass the income on to the individual who will then pay it at their rates. Very good. Corporations were the original liability protection vehicle. Still very good in certain circumstances. For if you're looking to raise equity, outside investors, it's much more if you want to give stock options and other things to employees, those are available to you through a corporation. S corporations let you avoid double taxation, but they are more restrictive on who's allowed in them and how they're operated. But those are all good things to sit down and talk to your tax advisors about to really hone in on what would be the right choice for you.
This was, very, very informative. And I know there's so many factors that go into, which legal entity to select. What do you see, Rod, in your experience working with small business owners? If a business is doing, say, $1 million to $5 million in revenues, where do you kind of, I mean, the best advice is given when, you're meeting with someone and really understanding where they're at and where they want to take their business to. But what do you commonly see? What's kind of the preferred? What do you see most of?
What we see most of is limited liability companies, just due to the flexibility and relative ease of establishment. So I would say 70 to 80% of what the organizations I see, it's unlimited liability established. So I mean, those serve their owners quite well. I mean, unless you're planning on a public offering or, like I said, stock options or other things, really a true corporation is much more involved. It has a higher paperwork and compliance standard than an LLC. So for most small business owners, the LLC is the right choice, barring other circumstances.
Yeah. And just for the listeners, when we use the word corporation, we mean C corporation, right? And when we, if you form an LLC, you can be taxed as a partnership, or you can elect to be taxed as an S corporation. So you have that flexibility. And deciding which way to go is really, doing an analysis to see which one's going to favor you from a tax standpoint. And we've seen, a difference of like thousands and thousands of dollars where one may make sense compared to the other. So you may be an LLC and it makes sense to do, have it taxed as a partnership or have it taxed as an S corp. So major significant difference in taxes. And I guess that brings to my next question, Rod, is how often should one review their legal structure?
I tell you, it's I would say at minimum every 3 years, sit down as part of your overall year-end planning, look at your legal structure to make sure it still suits what you're looking to do. That's at the minimum. If you have significant changes, such as you wanting to add a new owner, exceptional growth, or maybe potential acquisitions you want to do, that legal structure may or may not be your best fit with those circumstances. So you should sit down with your professionals, your CPA, and really go through that and talk about what you want to do, and then you can make a decision. But at minimum every 3 years, to make sure that it still fits and you're doing the right compliance.
Yeah, and ideally every year as part of an annual strategic meeting. And an annual strategic meeting is, let's review how your year was this year. Where are you planning to be next year? What are your pro formas, the forecast for next year? And based on that, determining what's going to be the right legal structure. And if there's significant changes in your business in the coming year, then it warrants to kind of, do a more of a deeper dive and say, hey, which one's going to serve you in the best way possible.
Very much.
So now I want to ask you a question that I've been asked quite a bit in my 30-year career as a CPA is, you'll meet with a business owner and they've read stuff on the internet, about, tax-free states like Nevada or Delaware, big one. And the question that comes is, hey, should I form a corporation or an LLC there instead of my home state? What's your response to that?
My primary one is, even if you form your business in a tax-free state, if you're located in another state, you will still have to file your taxes for that state. So if I file in Nevada, but I actually do all my business in New Jersey, I would still have to file a New Jersey tax return. I would have to and actually I'm increasing my level of tax reporting, because I have to file a Nevada tax return, and then I still have to file a New Jersey tax return and register as a foreign entity doing business in New Jersey. So there's actually another level of compliance. So for the most part, it makes sense for you to file, especially for small businesses, in the state in which you plan on doing them, where you're located and you're going to do the majority of your business.
Yeah, and so, in New Jersey was the example here, but you can be any state, California, Wyoming, Texas, any state, Colorado, and you want to form your entity there. Because if you form it in a tax-free state, then you're, as Rod said, you're going to have, double, triple the compliance. And I'm not in favor of more compliance. I want to try and keep compliance to the minimum, right? So that's great, man. Very, very informative. In terms of like legal entity, what is it? Why is this subject so important? Any final words of wisdom?
I would say that, take the time. It's a short investment of time for a big payback and a big peace of mind. So picking the right legal entity can help you protect your assets, save taxes, and help you grow as you expand your business. So I think take that little bit of upfront time to really think about it and work with your professionals, and it will pay dividends in the long term.
That's great. Rod, thanks a lot for your time. Appreciate it.
Thank you. And if anybody I don't know if your people have questions or anybody listening, please don't hesitate to reach out and we'll happily work with you.
Yeah, that's great. Yeah, in the show notes, we'll have our contact information, Rod's contact information.
Okay,
so if any follow-up questions, please do. Thanks, Rod.
Okay, thank you.